All right, it's time. It's time to open Pandora's box. We're going to discuss time series analysis. Now, time series analysis is the most misunderstood and misrepresented topic in all of quantitative finance. And I say this as both an academic and a professional, someone who has taken undergraduate courses, graduate courses, PhD level courses, research seminars in time series analysis, econometrics, but also somebody who has deployed production systems using these techniques for pricing and market making. I see the disconnect. I see the disconnect in the classroom. I see the assumptions that professors are making that are immediately violated in practice. And largely the reason for this misunderstanding and disconnect is because what is trivial isn't always what's spoken aloud. Nobody wants to ask these questions to get a better interpretation of it, but we need concrete examples to be able to understand these techniques if we have any hope of implementing them in practice. So in this video, what I want to do is correct a lot of misinterpretations and misunderstandings associated with time series analysis, talk about the major tasks that is filtering, smoothing, and forecasting. Want to move on to this idea of a prediction, the fact that there is no such thing as a prediction, and largely that's thanks to machine learning and artificial intelligence. Then I want to discuss this idea of alternate data and how we can use alternate data to improve forecasts in some cases, going beyond just simple time series models. And we're going to use The Big Short as an example. As expected, there's a time series pun for you. This Jupyter Notebook will be linked in the description below. I will also post it on the Quant Guild library on GitHub, where you can find all of my Jupyter Notebooks and associated YouTube videos. At the top of this Jupyter Notebook, you'll find some related Quant Guild videos on ideas like applying statistics to the market, the idea that even though our model is incorrect, it does not preclude us from generating wealth over a series of trades over time if we have edge in some sort of trading model and if we size our bets appropriately. So if you're unfamiliar with those ideas, I certainly encourage you check out those videos. Moreover, if you'd like to support the channel so I can continue to create videos just like this one, and if you'd like to master your quantitative skills, check out quantguild.com. Quantitative finance is such an interdisciplinary field, combining ideas from statistics, computer science, finance, math. The list goes on. There's so many places to look, so many things to learn. That's where quantguild.com comes in. We have over 90 quant lessons targeted in math, probability, finance, an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics. Interview questions with fully worked solutions. Coming soon, classes in math, statistics, coding, all from the ground up, all included with Quant Guild membership. So if you'd like to support the channel and master your quantitative skills, check out quantguild.com. Without further ado, let's begin with this idea of a time series. What are we actually performing analysis on? Well, all a time series is a collection of observations over a series of time, and typically these observations occur at equal time intervals. So you could think of something like a stock's closing price. We observe it every single day, and we plot that chart and we get the stock's price over time. Okay, that's typically what we see when we look up a stock chart. We see these regular time intervals, evenly spaced. Now, this doesn't have to be the case, right? We could have an irregular time series as well. You can think of something where we're missing data. Maybe we're looking at some sort of illiquid product that only trades every now and again. We're not going to be able to get information at those equally spaced increments necessarily. And what that's going to do is create an irregular time series where the time interval is not uniform. It's going to be dictated based on when we see those observations. So both of these can be the case. And another key component of the time series is this sort of piecewise linear interpolation. What we're actually doing is connecting the dots. You can see it more in this irregular time series example here, but we're kind of just omitting everything in between the 2 points in time. We don't know what occurred between those 2 points in time. We're just connecting the dots via this interpolation. So another important component of the time series. Same thing with the close to close. If we were looking at some sort of stock price, even though this is a regular time series between 2 points, we don't know what's happened. So definitely worth mentioning. Moreover, with these time series, statistics tend to be elusive. This is for one of a variety of reasons. And this could be due to lack of stationarity. This could be due to having a unit root, depending on the series that we are working with. So as far as a time series goes, this is what it looks like. But it's important to keep in mind that any sort of analysis we do on this particular path is analysis on something and some quantity. A lot of folks will forget this when they start to analyze their time series path. You still have something underneath functionally that is occurring, right? So if this is a stock price, you have a company that is functioning and is going to impact the value of that stock price. And that is completely separate information from what is being portrayed in this price. Now, the price is consequence of that company's operations, but there are things that occur and information that can occur outside of this price series that can be used to inform it. And we'll talk about that later on, but it's a very important distinction to make and a very important note. We can't lose sight of the actual values that are being plotted on this chart. Broadly speaking, a time series can be decomposed into trend, shock, and seasonality. Now, each one of these things doesn't necessarily have to be present or stable in a time series. Let's first discuss what these are, and then we'll discuss what I mean by present and stable. So take a look at this time series example up here. This could be sales over time. This could be a stock price over time, whatever you'd like it to be. And I've conducted this time series decomposition, and I've identified a trend component, I've identified a seasonal component, and I've identified some random shock or noise component. Now, when we look at a time series and we decompose into these different components, we have to indicate what these are. So trend is this long-term underlying directional move, this overall trajectory, okay? Seasonality is a pattern that is occurring over these fixed intervals. And then a shock or residuals are random fluctuations or unexpected events in the data. Now, this isn't as satisfying as it should be, but these random shock components are still being defined in an expected way. And that becomes more apparent when you look at specific models. But for now, we're just going to talk about this idea of trend and seasonality. There's nothing ensuring that this trend continues in the future. There's nothing ensuring that this seasonality continues in the future. When we look at a time series in this decomposed sense, what we're saying is, okay, it tends to exhibit this trend component. It tends to exhibit this seasonal component. Should this continue, then we can expect similar behavior in the future. And that's why I really like this idea of an expectation, not this idea of a prediction, because it's telling you what is expected behavior if status quo continues. Now, if this is some sort of business, right? Let's say this is a tech business and a new product comes out. Maybe some sort of AI product comes out and it kills the viability of this product. Then this trend component is gone. In fact, it might now exhibit a negative trend. If you tried to apply this idea to a stock price, you would see this happen all the time if you did it on a short time interval. You would have this trend component, and then eventually the trend component is going to flip in the other direction, and you're not going to get any meaningful information from it. So this goes into the idea of stability. And if these components are stable over time, and everything continues as status quo as expected, then it can be useful information. If this was a corporate budget, if this was sales, this could definitely be useful information. But like I said, those big regime changes are not accounted for in this information. So that is kind of this distinction that I'm trying to bring into this space. Is we take a look at this, we see these shock components, right? There is this randomness that's being accounted for, isn't there? That's what we're seeing in these random fluctuations. We see this overall trend, we see this seasonality, but aren't those unexpected events being accounted for in this shock component? Not entirely. We're defining that shock and that randomness in a very specific way. So there's a lot of moving pieces here in this space, but we can see that this trend component, this seasonal component, really the big idea here is if those are stable over time, then we can expect similar behavior in a forward-looking sense. If they're not, think something like trying to apply this idea to intraday stock prices for trading, you will not see any sort of stability. It will not be useful information for you to trade around. Now, relative to the shocks in our time series, that is these irregularities around an otherwise stable trend and seasonal component, we have a couple of different tasks. We don't necessarily know what's causing these spikes in either direction, and typically in a model we assume something about these shocks. We assume something about these errors. Maybe they're normally distributed, maybe there's a variance in these shocks that evolve over time, maybe that variance is constant depending on your model. But when it comes to this series, our objective is going to be to try to discern its state without the noise component, this sort of expected mean level. And that brings us into the different tasks that we are going to try to perform. We're going to try to either filter, smooth, or forecast. So filtering is estimating the current state using past and present data to try to reduce that noise. So if we take a look at this time series here, we should have a nice smooth seasonal component and a trend component, but it's choppy. What we're trying to do with filtering is discern what the actual state is, devoid of that noise, devoid of these shocks. Now, of course, it's not entirely satisfying because those irregularities, we're trying to define them in a way that's productive, but again, those are irregularities. It's not going to even account for all of the irregularities that we're going to observe. We could observe massive regime shifts, just like in the case of a new product coming out and destroying our company's sales. But in this example here, what we're looking at is a time series. This is our data, this blue line, and I'm applying this filtering technique. It's a moving average, and all that's going to do is take a window of these points and take the average, and it's going to continue to roll that window forward. And you can see this confidence interval band. That is essentially the confidence that the data lies within those two bounds. That is a filtering technique. We're trying to produce the current state. We're trying to use past data and current data to figure out what the current state is, devoid of this noise. This is not predictive. So if you throw a moving average over a chart on TradingView or any sort of trading program, that's all you're doing, is you're trying to remove this noise to discern the current state. It says nothing of what the future state's going to be. Smoothing is the other direction. We're actually looking backwards. We're trying to figure out what the state was. So we're trying to use current data and future data to look back and figure out what the state was devoid of this noise. This is interesting because it requires global path knowledge. You can roll this forward. That starts to look like filtering, but here what we're doing is we're even using values up here to inform values back here, and that creates this purple line. This is an exponential smoothing technique, and what this is doing is it's trying to tease out where the actual state of the time series was based on the global path that we have access to. And of course, we have this idea of forecasting. And forecasting is going to be essentially trying to produce an expectation, a best guess at what is to come based on what has been observed. and the current state. Forecasting is a great source of confusion for students, traders, non-technical people, because it's very easy to look up on YouTube how to predict stock prices, or on Medium how to predict stock prices. You get an article, you get all this code, it shows you a model that says fit and predict, and all of a sudden you're producing forecasts, these predictions, use predictions very loosely, that will always certainly be incorrect. And it's very difficult to understand why, because the wrapper around these techniques is using a word like prediction. And you're not predicting anything. You're producing an expectation. If status quo, that expectation might be reasonable. If not status quo, it is terribly unreasonable. And I've talked about this at length in one of my previous videos called What Does AI Actually Learn? The expectation in the face of randomness, whether you're looking at a random event like a dice roll, or a random event like the closing price of Apple tomorrow, the expectation is the best that you can do. If you're using more advanced techniques, it's a non-linear conditional expectation. Check out that video on What Does AI Actually Learn if you're interested. But this is why forecasts are and always will be wrong. If you roll a dice, the literal best guess that you can give is the expectation. If I rolled an infinite number of dice, the quantity that is going to minimize the mean squared error for all of those rolls is 3.5. That is my literal best guess. A dice can't land on 3.5. It can't land on 3.5, but that's still my best guess. So without a crystal ball, there's no such thing as a prediction. All right, it's very important to understand this idea. The expectation is a far better characterization of the space, because if things evolve as expected, then this is what the future could look like at best with status quo, but at worst we are violently wrong, and this can happen with massive regime changes. All right, we barely have a measure for what a good expectation actually is. I've talked about this in the past too. There's no such thing as expected stock returns, so on and so forth. You can check those videos out if you want to dive into those ideas. But let's just solidify it with a whole bunch of examples and come up with some very intuitive interpretations. I think that's going to be the best way to go about this. It's worth noting before we look at these intuitive examples that even though these forecasts, expectations, these levels are difficult to estimate and are incorrect, it doesn't preclude us from making optimal decisions in the face of uncertainty if our models are correct on average. And this makes sense, right? If we have a series of decisions that are being made, having a model is certainly better than not having a model. We're dealing with randomness, an uncertain outcome. And our goal is to find some sort of edge in that decision making in the face of uncertainty. And a model certainly can inform that. So we'll see an example of this in a market making capacity. And even though these assumptions are violated in practice, these models are still effective at accumulating wealth over a series of trades over time. So that's when it'll become more apparent. But for now, bear with me. We'll talk about these assumptions and we'll talk about the implications in practice. When it comes to model forecasts and the associated model assumptions, some are more insulting than others. If we look at something like a no arbitrage assumption, it's not really a crazy assumption, right? If there's a static mispricing in the market, it's not a crazy idea that an institution with a low latency capacity is going to immediately trade that out, right? That's not a crazy assumption. Those mispricings, sure, they exist, but they're taken advantage of very quickly. So that idea is not too crazy of an assumption, and the impact in our model subsequently is not going to be that crazy. If we look at something like a constant volatility assumption, yeah, that's a pretty crazy assumption, right? With something like Black-Scholes, and I've discussed this at length in the pricing of exotic options. Yeah, we can't price consistently using the Black-Scholes model if we assume constant volatility. That is a violently wrong assumption. But if we assume a constant volatility, we can back out this notion of implied volatility and observe the implied volatility surface. That is a pretty significant use of the model, if nothing else, but to find this quantity of what traders are pricing uncertainty at. So models have different uses, different assumptions and implications, and models have different impacts in how you go about using them. But when it comes to time series analysis, the first thing that your professor is going to do is tell you to assume stationarity, that statistical moments are going to evolve deterministically, that is, in a static capacity over time, mean, variance, autocorrelation, autocovariance. And this isn't the case. This isn't the case in practice. I gave an example a moment ago with Apple returns, but this is true for a variety of different reasons. Regimes change. Companies 20 years ago aren't the same companies now. And their data generating distributions are evolving over time in a random capacity, and we're doing our best to model them. But it's a very important distinction because in the classroom, you're going to assume stationarity. In practice, you're not going to have stationarity, and you're going to have to deal with it. And there's a lot of different ways we can deal with it, but we need to understand, why this is the case in practice first, and then we can go about understanding different models to correct the violation of this assumption. Let's start to build this intuition, and to do so, we're going to look at a couple of examples, and we're going to apply this idea of forecasting, observe some sort of big regime change or event, and then look at the outcome and implication in the new model. An argument can be made here, stock prices have a unit root, so we should be using returns. Returns are stationary. If you try to test for stationarity, it's a little silly. There really is no reliable tests for stationarity. This likely has to be a separate video if we're going to dive into this idea of, unit roots. We're going to dive into this idea of stationarity and stationarity tests. If this is something you'd like to see in the future, let me know. That's certainly a more technical video. But for now, let's just talk about this idea relative to some sort of earnings event. So we have this stock price path, right? And this stock price path is status quo up until this particular earnings event. After this earnings event, you can see the stock price jumps all the way up here. It creates a new level, right? Our naive time series forecast is just going to produce this level here, right? Clearly, this is violently wrong. And there has been a massive change in the subsequent stock price. You can say that the dynamics of the stock price path have changed entirely. You could say that the return distribution changed entirely. You would have to model it and test it. It's a research question. It's an open discussion. It's likely more reasonable to model this forecast in two states of the world using the option market, using the straddle and what traders are pricing the uncertainty of this event at, and what they're pricing in the jump to be on the upside or the downside. That's likely a better forecast. Now, does that tell you which direction to trade in? No, absolutely not. If you had insider information, yeah, you'd be able to predict it. But without insider information or information from alternate data informing the outcome of this event, no time series model is going to be able to capture this effect. Let's continue to build this intuition with some more examples. Temperature is by far my favorite example because it exemplifies this idea of an expectation. What do I mean by this? Well, if I asked you in the heart of December, what do you think the temperature in New York City is going to be? Would you say 100 degrees Fahrenheit? No, right? You'd say probably something freezing, 20 degrees Fahrenheit. And let's take it even one step further. Let's say you said, okay, Roman, I think it's going to be 20 degrees Fahrenheit in the heart of December in New York City. I say, okay, let's say on that day it was 20 degrees Fahrenheit. What do you think it's going to be tomorrow? Would you say 100 degrees Fahrenheit if yesterday it was 20 degrees? No, you would stick with what? Something roughly around 20 degrees Fahrenheit. And this is the idea of time series analysis. It doesn't know anything that we don't know or can't understand qualitatively. It's trying to model these different components of trend, seasonality, and shocks to both of those components. And it's not going to extrapolate in any sort of magical way. Just like we saw with this earnings example, it's not going to be able to tell us if it's going to jump up or down. That's not what these models are being used for. They're being used to analyze status quo and extract this overall trajectory and seasonal component. If there is a structural break and things change, that completely changes the dynamics of the system. It could completely change the outlook and expectations associated with a model. And that's exactly what we see here, right? It turns into a larger discussion if you want to argue for stationarity, against stationarity, if you think the data generating distribution changed here or didn't change. But that is the intuition, is, we're looking at this in terms of some sort of expectation. Just think about that temperature in New York City as an example. It's the perfect way to understand not only filtering and smoothing, but also forecasting. It's expected state of the world. Let's talk about another example of time series analysis and bring in this idea of alternative data to inform our forecast. So what I have here is my bench press progress from January 24 to January 25. And what you'll see is my level was roughly around 350. So I was oscillating a little bit. Sometimes it goes up, sometimes it goes down. I have this variability in my performance. And then all of a sudden, it dropped. December 9th, 2024, it dropped down to this new axis here. I had to create a twin axis. It dropped so low to 45 pounds. What the heck happened? Well, I tore my pec. So I'm not bench pressing 350 anymore. That level is gone. That level is nowhere near what my current level is now and to present in 2025. That is a structural break in the system. The data being used to generate points for this time series is coming from an entirely different distribution than it was over here. And this is really what I'm trying to get in terms of status quo and a forecast. That time series model doesn't have that information. It doesn't have that information, right? Until we observe it on the time series. Here's the interesting thing. Could we get that information before it comes up in the time series? My doctor had that information. Anybody in the waiting room who chatted with me had that information. So there is a way to come up with a better forecast beyond just pure time series analysis using alternative data. That's how we can get information. I think this is a really cool way of looking at the space, because you can think about this now, not just in terms of my bench press and my terrible bench press now, but you can look at this in terms of a stock price, right? Jumps happen, but is there other information we can use and take advantage of? Can we get an edge before that jump is realized? I'm not talking about insider information exclusively. Talking about things like using pictures of Walmart parking lots, CEO facial expressions, sentiment. Is there any information edge to glean there? So that's a very interesting way to think about the space using alternative data. We'll continue with that idea in a moment. But for now, we're going to move on to this idea of forecasts and how we can use forecasts, even though they're incorrect and our models are wrong, to generate wealth. We have a pretty good idea of what a forecast is at this point, right? It's not a prediction, it's an expectation. And different types of models and different assumptions and different types of data will give you different expectations. But this isn't going to be correct, right? There's not one level. We can't directly observe that parameter. So what can we do? Is it okay if we're mostly correct? It turns out that, yeah, it is okay if we're mostly correct. And I have a pretty cool series of animations to go about showing you how this is the case. So what I have here is the outcome of a dice roll, right? The outcome of a dice roll does not change over time. Everything has a 1/6 probability, 1 through 6. And the expectation of the dice roll, the average value, is just 3.5. Okay, that's what I have here. I have a series of outcomes and I have this expectation. Now, if we're a market maker and we want to make a market for these dice roll outcomes, what I can do is I can use this expectation to quote a spread around, and I'll have this bid ask offer, and I will essentially be buying at the ask offer, selling at the bid, and collecting the spread around this expectation. Now, the dice rolls aren't going to change over time. That expectation isn't going to change over time. So I really don't have to adjust my quotes. If I run this animation, you'll see a market making animation in this capacity here. These are different realizations of the dice rolls. I'm quoting a bid ask offer around this expected level. I have arrivals according to a Poisson distribution, and I have buyers and sellers on both sides, and I'm accumulating this P&L over a series of trades. So this is a pretty cool animation, but what is it showing you? Well, it's showing you that even though the outcome is random, I was still able to accumulate wealth based on this theoretical spread because I know what the expected value is. Remember, the expectation is the best that we can do in the face of this randomness, right? Okay, well, this is a really easy problem, right? Why can't I just do this if I'm trying to make a market in an institutional capacity? Well, your mid price changes over time, right? Stock prices change over time. So your expectation, that mid level, is going to change over time. So what do? This is where time series models can come in handy. This is one of the places where if you apply these ideas correctly, the idea of a forecast, this expectation, this expected level, and are correct on average, you can realize P&L. You can realize wealth over time, and that's the goal. You're making optimal decisions in the face of uncertainty. You're collecting the spread. You have a different host of risks. I've talked about this in retail and institutional trading. Check out that video if you're interested. But what I'm going to show you now is this exact same market where I have buyers and sellers engaging with my bid-ask spread, my bid and my offer, and I'm going to have it so that the weight of the dice is going to evolve randomly over time. So I know theoretically in this market, the expected value is 3.5. So if this was a stock, the expected value didn't change, and we realized a whole bunch of different prices around that expected value. In real life, it's going to change, and that's what I have down here. In this market making example, I'm going to use a time series model to predict the expectation. Let's see how I do in terms of my P&L, but we're just going to use a moving average to try to discern what the level is. See, it's going to be moving just like a stock's price. And now I'm going to be trading around this theoretical level. My spread is going to be quoted around this theoretical mid price. And check it out. I was still able to accumulate P&L even though I didn't know what the actual expected level was. It was changing randomly over time, but I was correct on average. I was able to collect this spread and I was able to make a profit. This is the perfect example of, even though my model is wrong and I am certain it's wrong, I was able to make money. So now we get a really full picture of this space, right? Forecasts are not predictions, they're expectations. If these forecasts or expectations are correct on average, then we can generate wealth, as seen in this market making example. But what about that qualitative example that I was talking about earlier with my bench press, with information? Well, let's use the 2008 financial crisis as an example. If I just used the time series approach to modeling these credit default swaps, then what would it look like? Would the value of those swaps just have continued to increase over time? Well, yeah, right? If I use just a pure time series approach, then I'm going to get something that looks like this, right? I'm going to get some sort of forecast that's like, oh, if status quo maintains, then yeah, this is just going to continue to increase in value. But what actually happened, right? Look at The Big Short. If you haven't watched The Big Short and you want to get into quant finance, you definitely have to have watched The Big Short for sure. You know, that's on a short list of movies with, Wall Street, Boiler Room. Definitely check those out. But here we're looking at this time series model that is absolutely incorrect, right? We have this crazy default event and the value of these just went to the floor. But people were able to predict that outcome, right? If you look at The Big Short, a lot of people made out on that trade. But why was that the case? They didn't use some sort of time series model, right? They were able to observe What? That there wasn't actually any value? They used alternative data, right? Maybe they visited the homes in person. Maybe, they were looking at, default rates on mortgages, and they actually dove into the data. This is alternative data. We're not just looking at a time series of the prices of this particular instrument. We're using alternative data to inform what we think is going to happen that the market hasn't caught up on yet. Sure, maybe with technology and the dissemination of information now it's different, but this again is a really great example of, wow, like information predated that move to inform trading decisions beyond just cursory time series forecasting. And if you tried to use this time series model to forecast what was going to happen, you would be violently wrong. So I think this is a really cool way to look at the time series space, because you're getting a better picture of what it is you're actually working with, right? It's not just a line on a chart. There's some sort of data generating distribution. Something's happening to produce those points on the chart. And if you think in conjunction with whatever model you're using to forecast, smooth, filter, along with this alternative data approach, then you're getting a very full picture of the space. Now, as we saw in the market making example above, sometimes it is sufficient to just use a time series model. So we saw that in a market making capacity above. We can also see that in a pricing capacity here below. So what I've done is I've implemented what's called a Kalman filter. If you're interested in a video on this particular topic, I'm happy to do so. It's certainly far more technical. We'll get to this when I have my closing thoughts and future topics. Nevertheless, I wanted to show you what this looks like where we don't need alternative data. So in the sense of trying to forecast some sort of outcome, it may be entirely productive to just consider a time series technique, just like in the market making sense. So here with the financial crisis and these credit default swaps, yeah, the alternative data was necessary to make the appropriate forecast. In this market making sense, if we had that alternative data to prevent some sort of crazy, trading around a wild price movement, that could certainly help us, but likely we'll be trading at such a high frequency, it's not going to necessarily matter. We'll just adjust and continue to move from that new break, that new jump, whatever it is. And in the context of pricing, largely the former is the case. We don't need to introduce this alternative data. So what I've done here is I've illustrated an example of time series analysis in pricing where we have some sort of product that is extremely illiquid and it's only trading at irregular intervals, but we have liquid proxies for what the price of that instrument could be. That's pretty interesting, right? So we observe these red dots, which are trades, and then we're informing the price of that illiquid instrument based on how these other instruments are trading. So what you can see if we zoom in on any one of these points, right? As these other products are moving around, that is informing the forecast, the estimate for this illiquid product. So this blue line is tracking what it thinks the value of the illiquid product is at those points in time without actually observing it. It's using these other liquid instruments as a proxy. And that is the perfect application of a time series analysis. And this can even beat more sophisticated machine learning approaches. I've seen it in practice. So I wanted to emphasize that there are cases where alternative data can be useful to inform, but may not altogether be that necessary. So we looked at a market making example where that could be the case. Time series is sufficient. We looked at a pricing example where this could be the case. That could be sufficient. We also looked at some other examples in the context of, 2008 financial crisis, the bench pressing, where there's some sort of massive structural break and alternative information could be useful in a forecasting capacity. It's largely going to be based on your problem, but I think so long as we're considering this idea of alternative information being included in your analysis for some sort of forecast or lack thereof, then, that is certainly sufficient. To summarize, time series models certainly have their place, and they are more than sufficient for a variety of applications, even though they are, of course, incorrect, even without this idea of alternative data. Now, the space itself is heavily problem dependent. So our choice of model, our assumptions, the implications of those assumptions, whether or not they're violated, will definitely depend on the problem at hand. Moreover, in terms of forecasting, whether it's for this particular space that we're interested in applying these time series models or just blanket forecasts in general, they are expectations at best. Alternative data may in fact inform better decision making than just a raw expectation from these different types of models. That is essentially constructing a new model, and perhaps we can realize some sort of information advantage, some sort of edge before a realization in the associated time series. Some future topics I would like to discuss. I'd like to go into more technical detail into this space. AR, MA, ARMA, ARIMA models, definitely a more technical discussion. I'd have to gauge interest on this if we really want to sit behind these models in a technical capacity, define them, their expectations, go about forecasting with them, so on and so forth. I'd also like to talk about market making models. I think that's a very interesting topic. Avendala and Stoikov have a market making model that is very renowned and used even in market making competitions that, like Citadel will do with their students. I'd like to talk about the Kalman filter, definitely popular for non-stationary systems. I've deployed production systems with this technique. Maybe algorithmic systems using the Kalman filter, like a Kalman mini series, maybe build it in Python and deploy it using interactive brokers, some live data. If there's interest there, I'd love to build something like that. I know Arch and Garch have been requested, so that's certainly in the queue as well. And then maybe a more interesting topic would be some sort of like Vol surface arbitrage. It's very common to fit some sort of model to a market implied Vol surface and then do some sort of surface arbitrage. Of course, before that video, I would have to talk about model calibration, and that has been on the docket for quite some time as well. And that's going to do it for this video on time series analysis for quant finance. I hope you enjoyed. I hope you learned something. This is a tricky space, and I said we opened Pandora's box at the beginning of this video, and that's largely because we did. Everybody has an opinion when it comes to time series analysis, the efficacy of time series analysis. I'm speaking more towards the intuitive understanding of it. What is trivial isn't always what's spoken aloud. So I wanted to connect these ideas of, what we're observing on a chart to real life events. We look at something like an earnings event. We look at temperature over time. We look at me bench pressing and injuring myself. We look at something like market making and the evolution of an expectation, a price over time. And immediately, with those examples, all of our models are incorrect. And in different cases, in different states of the world, our model is still useful for making informed decisions in the face of uncertainty. And other times it's not. When we have those big structural changes, we look at something like an earnings call, and there's a massive jump in either direction, our model isn't going to inform that. We look at market making where we have this expected level, then yeah, it certainly can be sufficient in that capacity. So it's interesting, and then once you start to bring in this idea of alternative data, you can really inform decision making kind of in tandem with this idea of time series. And then of course, if you just bring in machine learning, we're talking about nonlinear conditional expectations. You can check that video out, What Does AI Actually Learn? And that really kind of connects all of these ideas very nicely. That being said, thank you so much for watching. If you'd like to see more videos like this one in the future, please like, comment, subscribe. Let me know if you want to see any of those future topics. Check out Quant Guild on Discord. Check out quantguild.com. Master your quantitative skills. Other than that, I will see you in the next video.